Hi, and welcome to this week's market presentation. Latest news. In international news, the European Union passed its 18th sanctions package against Russia. The latest package of sanctions will now introduce a ban on the import of refined products made from Russian crude. This will impact roughly 15% of total seaborne diesel into the bloc as part of distillates from India and Turkey. Additionally, the European Union will now reduce its price cap on Russian crude from $60 per barrel to $47.6 per barrel. Now, the G7 cap remains unchanged as the US has yet to come on board with reducing the current cap. And then lastly, the shadow fleet will see an additional 105 vessels see sanctions, reducing the total number of available vessels to export Russian crude. Additionally, the sanctions package will include a transaction ban on Nord Stream 1 and 2, which will effectively prevent a restart of natural gas flows through Nord Stream 1 and also ensure that no gas flows through Nord Stream 2. The Trump administration, on the other hand, while remaining hesitant so far into introducing additional sanctions, has announced a 100% tariff rate on secondary tariffs if no peace deal is reached within the next 50 days. Now, it must be noted that previous deadlines have been given to Russia and extensions have been given. So it's still uncertain whether those will come into play or not. But this would certainly mean an increase in the activity in the US regarding sanctions on Russia. Weather. Moving on to weather forecast, temperatures across most of Europe are expected to moderate over the next 7 to 10 days, with particularly Western Europe seeing temperatures in line or slightly below the seasonal average. Countries in Northern Europe and in the Balkans in particular will still see above average temperatures throughout the beginning and middle of this week. But nonetheless, the cooling of temperatures will certainly ease some of the pressure on cooling demand and as a result on the power and gas markets. In terms of precipitation, we see a little more precipitation this week forecasted over the next 7 to 10 days. Particularly at the Nordic region, particularly at the beginning of next week, we're expecting higher levels of precipitation there. Then in terms of average wind speeds, we continue to see those remaining on the lower end over the next 7 to 10 days, potentially keeping wind power output from increasing further. Lastly, looking at the Atlantic tropical weather outlook, we note a less than 40% chance of a tropical or subtropical cyclone forming there in the mid-Atlantic over the next 7 days. Nothing too concerning at the moment. Macroeconomics. We now have inflation figures for the month of June for key economies around the world. Starting with the euro area, we note the stable evolution of the inflation rate year over year, with the monthly change at 0.1% over the previous month. Overall inflation rates in the euro area remain in line with the target set by the European Central Bank, potentially opening the door for additional interest rate cuts in the remainder of the year. Looking at the US, here we see an acceleration of inflation over the previous month. Year-over-year inflation now up to 2.7%, core inflation up to 2.9%. Most analysts attribute the increase in inflation to the tariffs that have been introduced by the Trump administration and warn that inflation could continue picking up in the coming months. This will certainly halt any interest rate cuts from being announced at the July Federal Reserve meeting, potentially leaving interest rates in the US at higher levels through the remainder of 2025. Lastly, over in the UK, we note a slight acceleration of inflation over the previous month, up to 3.6% for year-over-year inflation, and up to 3.7% for core inflation. Crude oil and LPG. Looking at crude oil markets, we note a slight decrease in price over the past week. Over the last few weeks, crude oil prices have remained relatively stable, for WTI hovering between $65 and $67 per barrel, and for Brent between $68 and $70 per barrel. The stability in crude oil markets is largely due to the more stable supply and demand outlook. On the supply side of things, good news coming out of OPEC Plus, as they announced that production quotas will be increased by a further 548,000 barrels per day starting next month. On the other hand, the relatively lower oil prices that we're seeing, particularly in the US, has been leading to a reduction in the active rig count for oil rigs in the US, potentially signaling a decrease in domestic production out of the country. On the demand side of things, the supply and demand balance has remained tighter during the summer period, as the strong cooling demand across the Atlantic basin is increasing overall demand levels. Looking further ahead, however, the uncertainty over the global economic outlook, particularly given the threatened tariffs that President Trump has been announcing over the last couple of weeks on its largest trading partners, weighing on future demand expectations. Natural gas. Looking at natural gas prices and focusing on TTF as a reference for European gas prices, we note a slight downward movement over the past week. The decreases were more pronounced for the front quarter of the year and for the first quarter of 2026. Here, the bearishness that we're seeing over the past week, likely due to one, the potential negative economic impact of tariffs being introduced by the US against European exports, and in the shorter term, also due to the slightly cooler temperatures being forecasted over the next 7 to 10 days, easing demand for natural gas. Looking further ahead to the forward year, we see a decrease of 3.5% on the week, also a reflection of the uncertain, potentially worse demand expectations moving forward, while the supply situation remains adequate for the time being, particularly given the decrease in price competition for LNG with Asian consumers, which has narrowed over the last week. Moving on to the fundamentals, starting with storage levels. Storage levels ended at just over 65% as of the end of last week, with the injection rate remaining relatively stable at around 4 terawatt hours per day. The injection rate has remained higher than last year's levels, which has helped reduce the storage deficit versus the previous year to just around 18%. Nonetheless, that still represents a significantly lower storage level capacity currently than last year, keeping some lingering concerns over the security of supply as we look to the winter months. In terms of total supply and demand, we note a slight decrease in total supply over the past week, pushing supply levels to the lowest levels since at least 2019, near the lows that were seen last year. On the demand side of things, demand has remained relatively stable over the past week and below the peak that we saw a couple of weeks ago. Looking at the European supply mix, we note a decrease in Norwegian gas flows to Europe due to some unexpected maintenance at Norway's gas infrastructure. And at the same time, we have seen LNG send-outs decrease over the past week as well, pushing below the levels seen in 2023. Nonetheless, the decrease in those Norwegian gas flows has led to an increase in LNG imports over the past week to compensate for the loss of those gas flows. Looking at LNG imports now, price competition with Asian consumers, which had increased over the previous couple of weeks, due in large part to the widening of the price levels between Asia and Europe, has narrowed over the past week. And given the higher cost of shipping LNG from the US to Asia versus Europe, we are now once again seeing a larger profit margin for US exporters going to Europe than Asia, improving the supply outlook for Europe. Coal. Moving on to coal prices here, we note the decrease in the price level over the past week, similar to the decreases that we've seen across natural gas markets in Europe. Adding to the slight bearishness over the past week that we see in coal prices is the improved supply outlook, as South African exports are expected to increase by 0.8 million tons over the next month. And also the slightly lower demand expectations, particularly as temperatures have cooled down, reducing demand for coal-fired power generation. EU and UK emission allowances. Looking at emission allowances, we note very limited movements on the European side of things, with the UK market seeing an uptick of 3.6% on the week. The upward movement on the UK market is likely driven by the reporting that the European Commission continues to work through starting negotiations with their UK counterparts on linking the EU and UK carbon markets. Now, it must be noted that progress is still expected to be slow, as per one EU diplomat who stated that he does not expect for those talks to begin before September. Nonetheless, the prospect of that linkage is certainly continuing to add support to UK carbon prices. Looking at European power sector emissions there, we note an evolution in line with last year's levels, still at the bottom of the range since 2019. Electricity. Moving on to electricity markets and focusing on the German power market as a reference for Europe, we note a similar price evolution as with natural gas, with decreases across the curve, with those more notably seen in the shorter term. The last quarter of 2025, for example, have seen a decrease of just under 4.7% on the week, with the front year seeing more modest decreases of 2.2%. Here, a big driver of the decreases in electricity prices is certainly the decrease in both natural gas and coal prices, reducing generation cost. At the same time, the same factors that were weighing on future demand expectations on the gas market are similarly weighing on power markets as well. When we look at the price evolution across other European markets, we see a similar evolution, with most markets seeing decreases over the past week. Moving on to the fundamentals and starting with total grid demand and residual load, there we see that continued increase in residual load, but still at the bottom of the range since 2019, while total grid demand has remained slightly more stable over the past week, but nonetheless has come down from the peak that we saw a couple of weeks ago due to the slightly cooler temperatures we're having now versus then. In terms of the European electricity supply mix, there we're certainly noting the very strong performance of solar power generation this year, reaching a new record high share of close to 17%. At the same time, the improved performance of the nuclear power sector has then also helped reduce demand, particularly for fossil fuels, although the poor performance of hydro and wind are adding support to those sources of electricity. Starting with nuclear generation there, while we note a decrease over the past week, particularly across the French nuclear fleet, we are still seeing output levels at the top of the range since 2019, very close in line with the levels we saw last year. In terms of renewable power generation, well, we've seen that come down over the last few weeks to below the levels we saw last year. We are seeing a slight uptick over the past week. And then looking at fossil fuel power generation there, we note that slightly steady increase over the past weeks, but nonetheless still remaining at the bottom of the range since 2019. Over the past week, we saw a slight uptick in solar power generation following that sharp drop a few weeks back, and still remaining at a record high level for this time of year. On the other hand, particularly looking at wind power generation, we're still seeing those decreases week over week, now near the average since 2019 through 2024. Then in terms of fossil gas generation there, we're seeing a more stable evolution, particularly as temperatures have moderated to some degree. And now those are near the same levels as last year, which are at the bottom of the range over the last 5 years. On the other hand, hard coal generation has seen a slight upside there over the past week. Lastly, looking at the guarantees of origin, we note a lot of volatility over the last few weeks. And over the past week, following the sharp increases we saw the previous week, we're now seeing sharp decreases again. Those most notably felt for the 2025 and 2026 production years. With several key players across Europe settling their positions for 2025 and for the year ahead, they could be having an outsized impact on the market and on price movements, adding to the general sense of volatility. Nonetheless, a potentially improved outlook for renewable power generation for the second half of the year could be another factor driving some of the decreases that we saw over the past week. That covers this week's market presentation. Thank you for joining.